In this video, we're going to explore the basis trade executor, which is a delta neutral funding arbitrage trade engine, where if you have a basis markets NFT, you can get access to the BTX and start trading in a few simple clicks and executing these basis trades. So by the end of the video, we'll understand what exactly a basis trade is, the risks and the benefits of executing a basis trade, and go through and understand how you can unlock the BTX and get access to it in the first place. So to start off with, to get access to the BTX, you'll need a Phantom wallet and you'll need to have a basis markets NFT. So a basis markets NFT can be bought on any of the reputable Solana NFT marketplaces. Here's Magic Eden, for example. You want to be sure that you're purchasing an NFT as part of a verified collection. So these pink ticks here are essential when you're looking at these NFTs on Magic Eden, and other marketplaces will have their verified collections available, but just ensure that you are purchasing from a verified collection. So once you've got an NFT, you can now log into the BTX. So all that you need to do is navigate to the URL that you see here, BTXXYZ.basis.markets, select your wallet with the NFT in it. There we go. So now that we are in the BTX, we can see all of the opportunities that are available for that delta neutral funding arbitrage. So here we have comp paying 30% APR, so 30% returns annualized over the year, 1 inch at 16.45%, and all of these other opportunities. And there's quite a list. So at the moment, we only support Binance, but Bybit is underway and will be integrated in the coming weeks. So that's quite exciting when we'll have multi-exchange funding arbitrage available, and the opportunities become even more so in that case. So you have different views on the BTX here. So we can go in the card view or the table view. The table view is quite nice, I think. And we'll go through and understand what exactly a reverse basis trade is and a traditional basis trade is, but the borrowable amounts are quite important. And in the new update, we've got those as well. Settings. Here, you'll need to input your API keys from Binance to start executing with the BTX. So here we've got the Binance API keys that are currently connected to this account. You'll need to go over to Binance, follow their guide on API keys. I'll leave a link in the video description to get that set up. But once you've got your API keys from Binance, you can head over and put them into the BTX, and that's quite simple. The most important thing with the API key creation is that you enable these parameters here. So enable reading, enable spot and margin trading, enable margin loan, repay and transfer, and enable futures as well. But once you've got that set up and you're in the BTX, log the API keys, add your account, and you're good to go. So there's a full guide here actually on pinned to the basis markets profile. So if you go through and follow everything in this guide, you shouldn't have an issue with getting set up on the BTX and starting to execute these trades. So everything is covered there. But what I want to focus on mostly in this video is not only the BTX and executing trades there, but what is a basis trade and what actually is happening when we do execute a basis trade, and why the BTX is so useful in doing this compared to doing it manually or through other platforms. Let's go over and have a look at this page that's been set up. So what is a basis trade exactly? To the middle of the page, and we'll go through it one by one. So with a basis trade, the funding is our profit. So the funding rate is our profit, and we're looking to take advantage of that funding mechanism to earn while we don't have exposure to direction. So we don't want to be exposed to the price going up or down. We just want to be collecting that funding that exists every 8-hour period on Binance and Bybit. FTX was good back in the day when you had the hour rollover of the funding rates, but that's no longer a thing. But now every 8 hours, we have an opportunity where we can collect the profits from longs or shorts who are willing to pay us just to have open a long or short position. The spread is our enemy, so getting in on each leg. So when you're in a basis trade, I'll go through this in a moment, but you'll have a long position and a short position. And managing the entry on those, you could have a pretty outsized spread that eats into your profits immediately on the initial position, because that's already eating into, you're looking at, say, an 8% APR trade or a 10%, even up to 30%. If you're eating 1 or 2% already, you're very much doing yourself a disservice in not most efficiently executing that entry. And it's the same on the exit. You could be chewing up to 5% on the entry and exit, which is obviously not a good thing when you're looking at profits over the year of 8%, 10%, or 30%. At times you can get crazy funding rates and earn 50% plus, but that's few and far between and doesn't last anywhere near what we'd want it to last in this market. The funding fluctuates with the time and market moves, but the most important thing is to understand why funding is priced as it is. So if we have something that's massively negative and the shorts are piling in and happy to pay us for being short, why are they doing that? Is it some kind of FUD? Is there, Binance has been one recently. BNB has been paying a negative funding rate for quite some while with the DOJ and all of the talk and bad vibes around Binance. Shorts have been happy to sit in those shorts and pay longs the funding rate because they're expecting price to go down with some kind of regulatory action coming down upon Binance. So there's no directional risk on basis trades once entered, but it is definitely not a passive strategy. The funding rate is always changing and you need to manage the trade once you're in it because if the funding rate is negative and you're in a reverse basis trade and happy to collect the funding from shorts, there could be periods of weeks and months where that funding rate is no longer negative and it's turned positive, and you need to rethink the reasons behind being in that trade, because then all of a sudden being in a reverse basis trade will not be profitable when the funding rate turns positive. So what is the funding rate? The funding rate is a mechanism that is used to keep the perpetual contract, the futures perpetual contract, in line with the spot market. So if we have the spot market trading above the perp, that means that the perpetual contract will be trading with negative funding. So we've got funding here. If the funding is positive, let's draw it here. So if the funding is up here and positive, that means that the spot contract is trading below the perp. So if we look at price over here, so say for example, price is doing something like this on the perp, while spot is doing something like this, that would mean that the funding rate is positive because we have the perp trading above the spot. And typically times like this, it's a bull market or people are positive on that particular coin and they're happy to bid up the perp and pay to be long. So that differential that exists between the perp price and the spot price is the funding. So that difference there is the funding, which is what we see on the funding chart here. So positive funding equals the perp paying or trading above the spot price. And then when we see the funding rate go back below zero and be negative, that is the opposite. So we'll have the perp trading below. It typically happens in downtrends like this, where there's some kind of catalyst for the perp to be trading in that way. So the spot would be trading above the perp. So in that scenario, the longs will be getting paid by the shorts because the shorts are comfy being in that trade for whatever reason it may be. And that would be a reverse basis trade. So when funding is positive, we have a traditional basis trade where you're collecting the funding from people that are long. But then when the perp trades in negative territory below the spot price, and we have a negative funding rate, that is a reverse basis trade. So if we sum that up here, we would be in a traditional basis trade when funding is positive over here. And then down here, we would be in a reverse basis trade. So that's where we're starting off at. So we'd be a traditional basis trade when funding is positive, and when funding flips negative, a reverse basis trade. So all that means is that over here, when we're in reverse, we would be collecting the funding rate from those that are short. And over here, we would be collecting the funding rate from people who are long. And that's to start off with the funding rate. Hopefully that gets your head around it. So what that looks like in terms of price, if we've got a regular basis trade where the spot is trading below the perp. So you'd have the perp like I just drew earlier, the red line here, trading something like this, probably. And then we'd have the spot trading something like this. And where we make our profit, of course, is the funding rate, and that exists here between the two. And the funding rate exists so people are incentivized to come in and start bidding up the spot or start selling the perp to bring the perp and the spot markets back in line. Because obviously, if there was no mechanism like this, we'd have a big disconnection between the markets. If there was no incentive vision for people to come in and sell the perp or long the perp to get it back in line with the spot market, then we'd have a massive gap between, what the perp does and what the spot does. It could be something like this, and we'd have a big disconnect in between the two. And that's, of course, not what the market makers want. That's not what a healthy market looks like at all. So that is the reason that this funding mechanism exists in the first place. And for a reverse basis trade, we'd be looking at the perp doing something like this and the spot trading above that perp. So we'd be looking at it like this. And the funding, of course, is again the difference between. In this case, it would be negative funding because the perp is trading below the spot market. So hopefully that gets your head around what exactly we're doing here and what we're trying to take advantage of. And you can see quite clearly that if we're taking a position in the spot market and in the perp market, they're heading in both in the same direction. Price is quite consistent, and we can take a long position and a short position on the same coin or same token and not be exposed to direction, because you've got a long betting on one way and a short betting on the other way. So you're not exposed to the directional risk. But what you are doing is collecting the premium that exists either, between the perp and the spot on the downside or the perp and the spot on the upside. And you're getting paid funding every 8 hours. An important thing to consider when you're looking at these type of trades is the stability of the APR. So if we look at the BTX, the opportunities page shows you the 7-day APR. So in the last rolling window of 7 days, what has the APR rate been? And that shows you the more stable APR rate and what you can expect it to be over the shorter to medium term. Whereas if we're looking at it on a day, you could have some kind of event that spikes the funding rate or drops the funding rate for a particular token only on that day, but it's totally different to the rolling window rate. So it's important to understand that stability of that APR is quite important. So if we have a 3-day APR stability that could look like this on a token, and it's jumping around quite a lot. So it's hard to understand, if I stay in this trade for 30 days, what's going to happen? Am I going to get paid, or am I going to get, shafted because the APR is not stable enough? And then if we look at the 7-day, it might be something like this, a little bit more stable. But then if we look at the 30-day, and we can understand that, we're getting paid if we're in a reverse basis, for example, and it's been a lot more stable. We're getting paid, say, 4 or 5%, for example, on this trade. We can be like, all right, the stability of the APR is quite good. I'm going to get in this trade for 30 days and hopefully get paid that stable APR that we can see in this chart here. So the stability of the APR is quite important. You don't want to be in a trade that's just going to last 1 day, because first of all, you're paying fees. You might be paying a bit of a spread on getting in and getting out of the position. And by the time that you're in this for a day, you might end up losing money, because the APR is not something that rapidly grows your account, but does grow your account over the longer term. So that's something to consider as well. And like I was talking about earlier with the funding rates, so the funding mechanism is something that incentivizes traders to come in and bring a market back into line. So the perp and the spot spread down the bottom here, the difference between the perp and the spot market. And then we've got trader incentive to act on the left. So the more that spot and perp spread apart, the higher the incentive is for a trader to act and come into the market. So it's something like that to visualize why this funding mechanism is so important and why it exists in the first place to bring markets in line. So with the BTX, we're taking advantage of this funding rate that exists, that incentivizes, people to come to the market and push the spot and the perp closer together to have a more efficient market. While doing that, we can use the BTX to get in on the position at the lowest spread possible and in the most efficient manner possible. So if we want to go and execute a trade right now, say for example on comp, it's been paying 30% over the last 7-day rolling window, and it looks like quite a good position to be in. We've got to check if we have borrows available. There's only 7 available, so not a great trade. If we look at 1 inch, well, it would be a great trade, if there were borrows available. But because we're going to be shorting the spot and longing the perp on a reverse basis, remember a reverse basis up here is where the perp is trading below the spot. So in this case, comp is trading below the spot, and we can see it here. So if we zoom into the 5-minute chart here, so you can see periods where comp is trading. The orange line is the perpetual contract, and the black line is the spot market. So the perpetual contract is going below the spot market quite consistently, and that's where our funding rate comes from, our negative funding rate. So if we want to execute on these trades, we've got to understand what's actually happening underneath. But for this example, we're going to look at 1 inch because there are borrows available, and we can get in on that position. So we can take our short position in the spot market, borrow 1 inch, and then we can long the perp in the perpetual market. So what we're going to do here is click on 1 inch to start with. Our position size is going to be $500 to start with. And then the batch size, which is, how many trades do we want to execute? So in this case, we'll do it at $100. Now the BTX will go in and start executing that trade for us on Binance via our API key. So now we're going to long the contract and short the contract spot, long the perpetual contract and short the spot market. So position execution initiated successfully. And now we can go over to our positions. Load that up, and we should have the 1 inch. Okay, so here we go. Get this warning. I've got to talk to Bull about that. I'm not sure why that pops up, but it's clearly not been modified outside of the BTX. But it's executing that trade. So what it's doing is limit selling on the short side, and then limit buying on the long side to get us in with no directional risk and just collecting that funding rate that exists between those two contracts at the moment, those two markets at the moment. And that's all there is to it. So that's the BTX. In a couple of minutes, you'll have opened a trade and you'll be collecting that funding rate. Now, all that's left to do is monitor the APR stability over time. So this ensure that you're consistently getting paid, that the funding rate in this case is consistently negative on our reverse basis trade, and that we can sit in this position for some time. You will also want to pay attention to, any news that comes out regarding the token. Overall, typically, this is not a passive strategy. It is definitely one that needs to be managed. It needs to be looked after. But we can open multiple trades at any one time whenever these opportunities pop up. So that's all there is to it, guys. Hopefully this was insightful. The BTX is quite a powerful engine, and we're constantly working on it and upgrading it to be bigger and better than what it has been previously. Make sure you're in the Discord and following us on Twitter. In the Discord, we'll be happy to answer any questions that you have, issues with the platform, issues with, getting API keys integrated. Also, the documentation needs to be looked at before you start off executing any of these trades and using the BTX. Please ensure that you're aware with all of the documentation and the risks associated with interacting with basis markets. So that's all for now. Hopefully you guys found some insight into this and start to get basis trading with the BTX.